Hello and welcome. This is Professor Swark, and today I'm going to walk you through Chapter 7, Selected Topics. I want to remind you that ACC sessions are selected tutorials or quick tutorials. You do need to read all of Chapter 7, take notes from it, seek help if you need help with any of the topics in this chapter, and once you're completed with the coursework, you are expected to be self-quizzing, whether through flashcards or just some quick sample problems that you continuously work through. You do need to practice in this chapter in order to do well. All right, so Chapter 7 is all about short-term receivables. We're going to talk about sales on account. That's a review. We're also going to talk about credit card sales. We're going to spend the bulk of our time in this ACC session on bad debts and what happens when customers don't pay their receivables. And then we're also going to talk about short-term notes receivable. So just a refresher on sales on account. If we provide a sale to a customer on account, the first thing that we do is we increase accounts receivable. That's an account that tracks cash that we're going to receive in the future. It's an asset account, so if we increase it, it's a debit. We're going to record a credit to our revenue account called sales. So the first two entries here increase our sale or record our sale. The second two entries decrease our inventory. So we debit cost of goods sold. That's an expense account. That's basically recording the expense of that inventory that we just sold. And we're going to decrease merchandise inventory. Okay. If we provide sales on credit cards, so this is the first part of your handout that we're going to review. So oftentimes companies will not sell to our customers on account, but we will sell on credit card transactions. So credit cards offer a couple of different benefits. Number one, they reduce risk. If a customer does not pay their credit card bill, it is not the company that sells. It's not, for example, the Walmart that takes that hit. It's actually the bank that provides the credit card. So it reduces risk and it increases the amount of sales that companies sell. So here's a couple of different transactions, and we'll talk about them as we work through them. So number A, or letter A, sold $2,000 merchandise that cost $1,800. So right away you should know that here's a sales transaction, and our cost records the reduction of inventory. So remember, the larger amount records the sale, the lesser amount is our reduction in inventory and cost of goods sold. The net cash receipts for these sales are immediately deposited in the seller's bank account. MasterCard charges a 5% fee. Okay, so the downfall of selling merchandise on a credit card is that we incur a charge from the credit card company. So first thing I want you to do is record the sale. So the sales is our credit, and the sale is always recorded at the full amount. The second thing is to go ahead and record the cash. Now, because these sales are immediately deposited in the seller's bank account, we just record that as a cash transaction. It's all electronic. We're not going to even realize there's a lag in time here. So we're not going to collect the full amount of cash. We're going to collect the cash or the sales transaction less the 5% fee. So $2,000 less 2,000 times 5%. Okay, and again, this is because we're immediately depositing this cash into the seller's bank account. So the fee is $100. We go ahead and record a $1,900 increase in cash. And again, this is because it's all done electronically. You swipe that credit card, it's all deposited into the seller's bank account immediately. The difference here goes to a selling account called credit card expense. This is just a expense account. It's a cost of doing business. It's a selling expense. $2,000, the cost of the sale, times 5%. That means we incur a $100 credit card expense. Now that's the top part of our transaction. Remember, we still have to record cost of goods sold and merchandise inventory for the lesser amount, the $1,800. Now in B, we're selling merchandise that costs $300 on an assortment of credit cards. Net cash receipts are received 10 days later. So you see that we highlighted 10 days later. This would be more of a mom and pop shop, a small shop that's still doing the paper transactions, or that swiping machine that sometimes you may have seen where it swipes over your credit card and then you sign the 3-part receipt. So this company is taking all those receipts, submitting them to the credit card company, and receiving the cash 10 days later. So it is not considered a cash transaction. We do, however, incur a 2% fee. So again, start with your sales. We're going to record sales at the full amount, $1,000. Then we're going to go ahead and record accounts receivable. So it's not a cash transaction since we have to wait. There's a delay in when we receive our cash. So we're going to go ahead and record it to accounts receivable, not for the full $1,000, but the full $1,000 less the 2% transaction fee. So $980. Where does that credit card fee go? It's just an expense, credit card expense, 1,000 times 2%. I'm sorry, that should be a $20 fee, not $200. Okay, we still have to record cost of goods sold and merchandise inventory for the lesser amount. All right, next thing we're going to talk about is what happens when customers don't pay. So that's called a bad debt when we have a receivable, not a credit card, but an accounts receivable balance that does not get paid. Some small companies can use what's called the direct write-off method, where we just directly, when we identify a customer that's not going to pay, we directly write off that balance. So here's an example. On July 15th, Riley determines it cannot collect $600 from Eaton Company, a credit customer. Prepare the journal entry using the direct write-off method. Okay, this is also on your handout. So if you think about accounts receivable, it's got a debit balance. It's an asset. We're expecting to receive the money. However, if we are not going to get that money, we want to write it off. How do we close out an asset account? We credit it. Okay, so AR for Eaton Company, we're going to close out with a credit balance. What are we going to record as a debit? We're going to record it as a bad debt expense. Okay, another cost of sales. We're just writing it off directly to an expense account for $600. Now, if Riley later collects $200 from this company, what do we have to do? It's a two-step process. First, we reverse the original transaction. Okay, so originally we debited bad debt expense and credited accounts receivable. We're going to flip that. We're going to credit bad debt expense and debit accounts receivable. That's putting the transaction back on the books. However, we're only going to do it for $200. Okay, we didn't get the whole $600, but we do need a spot for accounts receivable to actually put that cash. So a debit to accounts receivable for Eaton for $200, and then go ahead and collect the cash just like you would any other transaction. Debit to cash, credit to accounts receivable. That's leaving a paper trail here. Remember that we wrote off this account, we're going to put it back on the books, and then take it off. It's providing a trail of what happened. What about the $400 balance owed from Eaton? So a lot of times students want to know, okay, it was originally $600, they paid $200, what about the rest of it? In this case, it's written off. Okay, so it continues to be written off. We don't have to do anything with it. Perhaps we negotiated with this customer. The customer wanted to do continued business with us, but they could only come up with $200 at the time. Maybe we negotiated, we'll take the $200 and we'll sell to you again. So the $400 continues to be written off. It doesn't reappear. All right, most companies are going to be required by GAAP to use the allowance method. The allowance method basically comes in two different forms, percentage of sales or percentage of accounts receivable. But what the allowance method does is it writes off at the end of every period, it writes off the amount that a company expects to be uncollectible. Okay, so at the end of every year, let's say December 31st of every year, your company, you would go ahead and figure out, you'd analyze your accounts and you determine how much do we think will not be collectible. And history gets that pretty close. You know, maybe we decide that based on history, 2% of sales or 0.5% of accounts receivable are written off. Okay, so we just look at history, and companies get pretty good at doing this, and we determine how much is going to be written off. Why do we do this? To account for the matching principle. We want to match our sales, our revenues, with the expenses. So we're basically taking the expense in the same period of the sale. That's the idea behind this allowance method. There's two different methods, as I mentioned before. Percentage of sales, where you just take the sales times the percentage we think is uncollectible and record the entry. And there's a percentage of accounts receivable, which you can see is a little more complex. You take accounts receivable times the percentage, and then you have to look at this existing allowance for doubtful accounts balance and adjust for that beginning balance. Okay, so let me walk you through these two steps. First off, what is allowance for doubtful accounts? It's a contra asset account. It's married to the accounts receivable accounts receivable. If you look at a balance sheet, you're going to see accounts receivable less this allowance for doubtful accounts. And because it's a contra asset account, it has the opposite balance of an asset account. So asset accounts normally increase with a debit and decrease with a credit, but this is the opposite. Contra accounts are the opposite. So they're married to accounts receivable, but they have opposite balances. Okay, so if we're working with the allowance account for percentage of sales, Warner Company's year-end unadjusted trial balance shows accounts receivable balance of $8,000, allowance for doubtful accounts of $100 credit balance, and sales of $28,000. Uncollectibles are estimated to be 1% of sales. What's the year-end adjusting entry? Okay, again, we do not know who we're going to write off. We just know we want to record the bad debt expense in the same year as the sales. So we have to figure this out. Sales are $28,000 and we think 1% will be written off. Okay, so take your sales times 1%. That means we're going to write off $280. So we debit bad debt expense for $280. Now the credit goes to a new account called the Allowance for Doubtful Accounts, this contra asset account. What we're basically doing is we're filling up a bucket for a rainy day. Okay, we're kind of allocating a little bit of allowance here. It is what it is. We're filling this up in a bucket, and when we identify in the next year a customer that doesn't pay, we'll pull from this bucket. Okay, we'll empty the bucket as we determine a bad debt customer. We don't know who won't pay at this point. That's why we're just filling up a bucket and waiting for the customers that don't pay, and then we'll use it up. Okay. Now, if we're using percentage of accounts receivable, remember that one was a little more complex. So Warner Company's year-end unadjusted trial balance shows accounts receivable of $8,000, allowance for doubtful accounts of $100 credit, and sales of $28,000. Uncollectibles are estimated to be 2% of accounts receivable. So what balances are we going to use? Accounts receivable times 2%. However, don't forget, we also have to go ahead and look at the existing allowance for doubtful accounts. So our allowance for doubtful accounts has a $100 credit balance. When we use percentage of accounts receivable, this ending balance here, accounts receivable times the percentage, that's our goal. Okay, so we have to adjust for what's already in the account. We have a $100 credit already in the account. Remember that the allowance for doubtful accounts is a contra asset account, so a credit balance is normal. So we want to make the balance 160. So really all we need to do is fill it up with $60 more. Okay, we're filling up our bucket. We're going to debit bad debt expense for $60, and we're going to credit allowance for doubtful accounts for $60. Okay, right now if you adjusted this, or if you posted this entry and balanced your allowance for doubtful accounts, you would have $160 in it. Our goal was $160. By adjusting just the difference between our goal and the existing balance, now we fill up our bucket to $160. Okay, what about if we prepare a journal entry and Warner determines that $500 for HBC is deemed uncollectible? Okay, so now we're going to actually use the bucket. Instead of debiting bad debt expense, remember we've already done that at year end. So this is January 3rd. All we're going to do is pull from the bucket. So we're debiting allowance for doubtful accounts for $500. We're emptying our bucket, and we're writing off HBC's accounts receivable. Okay, some of you may have caught the fact that we emptied out more than we actually had. Remember we had $160, and now we're actually writing off $500. That's okay. At the end of the year, we'll pick that back up. We'll fill up the bucket for any deficits. Okay, and see, it says prepare the journal entry for uncollectibles if the allowance for doubtful accounts had a starting debit balance of $100. So we're going back to our original amounts. Okay, our year-end adjusting entry where it's $8,000 times 2%. Okay, so our goal is 160, but we start with a not normal balance. Our balance should be a credit balance, and we're starting with a debit balance. So what we have to do is we have to compensate in our journal entry. We have to add in more. This is an example of where we poured out too much. So here we debit bad debt expense for $260, and we credited the allowance account for $260. So what we're doing is we're wiping out that debit balance and adding in our normal balance. So it's $160, what we really want, plus we're compensating for the negative amount in our allowance account. Now, a quick memory trick here is that when you're using the percentage of accounts receivable, that's the only time you have to adjust for the allowance account, the existing allowance account. If you have a debit balance, a beginning debit balance in the allowance account, you add. So take the D in debit and think add. If you've got a beginning credit balance like we did in the first one, you subtract. Okay? But if it's a debit balance, the allowance account has a beginning debit balance, take the D in debit and add. Now, if it's percentage of sales, you don't care about this beginning balance. So there's a couple of tricks in this chapter. One is percentage of sales, keep it simple. Let me go back. There's no good way for me to go back. Keep it simple. Percentage of sales, do your multiplication, and quick do your entry. If it's percentage of accounts receivable, you have to analyze the allowance account. If it's a credit balance in the beginning, subtract the amounts. If it's a debit balance in the beginning, add the amounts like we just did. All right, so here's from your workout sheet, so we can just go through another example. Warner Company's year-end unadjusted trial balance shows accounts receivable of $9,000, allowance for doubtful accounts of $100, it's a credit balance, and sales of $28,000. Okay, so this is just a slightly different. Uncollectibles are estimated to be 1.5% of accounts receivable. Okay, so here would be a good point to pause the video and try it on your own, or you can just follow along. So if we want to go ahead and prepare the December 31st adjusting entry, first off, we want to take 1.5% of accounts receivable. So 9,000 times 1.5 is 135. That's our goal. Now we have to compensate for the $100 credit balance, so we're just going to make an entry for $35. What are we going to enter? Bad debt expense for $35, allowance for doubtful accounts for $35. Okay, we're filling up that bucket. And the bucket's balance is going to be $135. That's our goal, right? We already had $100 in there, so all we're doing is adding $35 more. So our bucket balance is $135. Okay, what amount would have been used in the year-end adjusting entry if the allowance had a debit balance of $50? Okay, so if instead we started with a debit balance, you'd go through 9,000 times 1.5. 135 is our goal. But we had a beginning abnormal balance, right? So we have to add that back in to compensate for a negative balance. So now we have to adjust for 185. Debit to bad debt expense, credit for allowance. Okay, what we did is we filled up our bucket here. Our bucket had a negative balance, so we put in more. We compensated, right? Our balance still, in the allowance account, the balance in our bucket will still be 135. All right, and see what would have been used in the year-end adjusting entry if Warner estimates uncollectibles as 0.5% of sales. Okay, sales, keep it simple. 28,000 times 0.5% is 140. Debit bad debt expense for 140. Credit the allowance account for 140. Okay, so a couple things to be working on in this chapter, in this unit. Know your journal entries. If you're filling it up, it's debit to bad debt expense, credit to allowance for doubtful accounts. If you found a specific customer, you're debiting the allowance account, you're crediting your customer's account. Okay, if it's percentage of accounts receivable, you have to adjust for the beginning balance. If it's a debit, we add. If it's a credit, you subtract. If it's percentage of sales, you keep it simple. You do your sales times your percentage, and that's your entry amount. Now, in your homework and on exams, we may give you more than you need. If we would give you this whole amount of data and we ask you for percentage of sales, you need to know that we don't care about accounts receivable. We don't care about the existing credit balance. Okay, so you need to weed out what do you need to know. And here's a good chapter for flashcards. Okay, then the last part that we're going to talk about in the ACC session is notes receivable. So notes receivable are signed. You can see here it's signed. It's a more formal agreement than accounts receivable. It tells the number of days that we're loaning out the money. It tells the day that the note was signed, the due date, the percentage. Okay. A couple things you want to know is the maker of the note is the person that signs the note and agrees to pay. The payee is the person that will be paid back the money. One of my students one time told me that they thought employee is the person that's getting the cash, right? So the payee is the person that's being paid back the money. The maker or the payor is agreeing to pay back the payee. Okay, we're going to learn how to compute interest. We take the principal times the interest rate. Okay, however, this is a annual interest rate. So if it was 12% and this is a 90-day note, 90-day note, we want to go ahead and take principal times the interest rate of 12% and multiply that by 90 over 360 days to figure out what is the interest for 90 days. Often students want to know why 360. It's a banker's rule. We do know that there's 365 days in the year, and when you're doing financial ratios, continue to use 365. But when we're computing interest, take it over 360 days. For computing maturity, start with the month that the note was signed. So for example, if you sign a 60-day note on June 11th, start with June. So June has 30 days in it. Take off the day that you sign the note. That means that we're going to count 19 days in June, but we want to get up to 60 days. Add in the next month. The next month is July. That's 31 days in July, which brings us up to 50 days, but we need 60 days. So how many more days do we need? 10 more days. So 10 days in August, that's the next month. Our due date then would be August 10th. Okay, so this is a simple way. You always start with the month, subtract off the day that you signed it, and then keep adding months and days until you get to the desired number of days. The last day that you write in there, for example, August 10th, that's the maturity date. Okay, a lot of students want to just say, okay, if it was signed on June 11th and 60 days would be about 2 months, so that'd be July, August 11th. That's going to throw you off, right? Because we're worried about exact days, so it's August 10th, not the 11th. Okay, the other thing that students want to know is, can they bring a calendar into the exam? And that is no. At the end of your printout, there is a little rhyme. In Blackboard, there's a tutorial on counting days of the month using your fingers. I don't care what method you do, but when you graduate, Harper, with Accounting 101 on your transcripts, I want you guys to know the days in the month. Okay, again, Blackboard has a cute little hand trick that's very, very easy to use. All right, so here's an example. On August 1st, ABC accepted a note for $2,000, a 90-day note dated August 1st, granting a time extension on a past due account of XYZ company. Okay, so this is a past due accounts receivable account. So what we're doing is we're saying, hey customer, you're not paying your accounts receivable balance. We're going to charge you interest, but we'll extend this into a loan. We'll give you a 90-day loan. So what's the maturity? Start with the day that the note was signed, August 31st. Minus off the day that we signed the note, August 1st. That gives us 30 days in August, and our goal is 90 days. So now we want to add in September. So September has 30 days, so that brings us to 60 days total, and we need 30 more days, right? So October 30, yes, there are 31 days in October. However, we only need 90 days. So 30 in August, 30 in September, 30 in October. That brings us to 90 total days. Our due date then is October 30th. What's the interest? Remember, we want to take principal times interest times the number of days divided by 360. So 2,000 times 10% times 90 over 360 means we have $50 of total interest. So on August 1st, let's record the entry. Remember, we're converting accounts receivable to notes receivable. Ooh, I've got this backwards. No, I don't. I'm sorry, I'm thinking payables. So receivables are an asset. If we're adding or increasing notes receivable, we increase it with a debit, and we're taking off or decreasing, closing out accounts receivable for 2,000. Okay, notice on the day that we actually record the journal entry, we're not recording or doing anything with interest. We have not yet earned it the day that we sign the note. On the day that on the maturity day, assuming the note is honored, that means paid, that's the day that we're getting cash and we're closing out notes receivable. Okay, so close out notes receivable at $2,000. Then record cash. You're getting not only the note amount, but also $50 in interest, so $2,050. If you notice here, my entry doesn't balance. I've got $2,050 in debits, $2,000 in credits. I need a $50 credit. What is that? It's interest. It's interest revenue. Okay, you've now earned $50 in interest revenue. Okay, if we extend our note over a year end, okay, there's a couple of adjusting entries we need to be worried about. So let's say on August 1st, ABC accepts a note for $2,000, 10%, 90-day note, granting an extension of a past due receivable. Okay, so what's the maturity date? The note's dated December 1st, not August 1st. So December 31st minus the day that we signed the note. Days in December is 30. Add in January, so we're up to 61 days. I need 90, so I'm going to go ahead and add in February, which unless it states it's leap year, assume 28 days. Add in one more day to make 90. So the due date of the note is March 1st. Okay, so how many days do we have till year end? Okay, just December, right? There's only 30 days of the note that are December. The interest earned in December then is $2,000 times 10% times 30 over 360, or $16.67. Okay, you would record this as an adjusting entry as a debit to interest receivable and a credit to interest revenue on December 31st. Okay, how many days are in the new year? It would be January, February, and March, so 31, 28, and 1. Okay, which would be 60 days. Interest earned in the new year would be $2,000 times 10% times 60 over 360, or $33.33. So on the maturity date, okay, close out notes receivable. Credit to notes receivable for the whole amount of the note. We're going to debit cash for the entire amount of the note plus all the interest. Okay, so $2,050. Now the tricky part is, what do we record? How do we split up this $50? Okay, what you want to do is you want to record interest revenue, but only for the amount that was earned in the new year. Okay, so $33, I rounded here. $33 was earned in the new year. What about the amount that was earned in the old year? Remember, it was recorded as a receivable. So now we're going to close the receivable with a credit to the interest receivable for $17. Again, I rounded. So here we're closing out notes receivable, we're closing out interest receivable, and we're recording interest revenue, but only the amount that was earned in the current year. All right, so here, let's do some practice. This is from your workout. So Dominica Company's December 31st year-end unadjusted trial balance shows a $10,000 balance in notes receivable. The balance is from 6% note dated December 1st with a period of 45 days. Prepare journal entries for the following scenarios. The adjusting entry on December 31st. Okay, so December 31st, first off I'm going to figure out what's the actual due date. Take off the day we signed it. There's 30 days in December. It's a 45-day note. So I need 15 more days, which would total 45 days. So how many days are between the day that I signed it and December 31st? 30 days. So let's figure out how much interest was earned before the year end. Okay, 10,000 times 6% times 30 days that were earned before December 31st is $50. So on December 31st, we record interest receivable, because we've not yet received it, we're going to receive it in the future for $50, and interest revenue for $50. This is the amount that was earned in the old year. Okay. The total amount of interest earned will be 10,000 times 6% times 45 over 360. So we earned $75 in total interest revenue. $50 was earned in the old year, and $25 will be earned in the new year. 10,000 times 6% times 15 days in January over 360 is $25 that will be earned next year. If you're struggling with the year end, here's what I want you to do. I want you to just make a little diagram. December 1st is the day that the note was signed. January 15th is the due date. I'm splitting this up by year end. December 31st is year end. Okay, you notice there's less days over here than there are in the old year. Okay, $50 is interest revenue that was earned in 2012. So remember, we recorded that with an interest receivable and an interest revenue. Interest revenue, or you have to record the amount that was earned prior to year end. You have to record that as revenue earned in this old year, 2012, for example. 2013, we're going to record the revenue that was actually earned in 2013. So $25 was earned in 2013. We're going to go ahead and record that interest revenue over here. We're going to close out our interest receivable and our note receivable. So you must record revenue in the year that it's actually earned, even if it's not collected. So on C, the note's maturity date, assuming that it's, we're going to start with assuming that it's honored. Okay, so we're going to start with B. Okay, so on January 15th, close out notes receivable for $10,000. Record cash, which is the receivable plus your total interest of $75. Okay, then you can close out, we're going to close the interest receivable that we opened up here. What's left is just interest revenue, $25. Okay, so that's a hard one. But if you just break it down into close out the note, record the cash for the entire amount, close out the interest receivable, and record just the revenue earned in the new year, it's a simple process. It's just multiple step. So keep working at it. Keep working at flashcards. Maybe split the flashcards into just journal entries so you get the hang of the journal entries, and then add in numbers later. Okay, in C, assuming that it's dishonored. If something is dishonored, it's not paid. Okay, so if it's not paid, the only thing that would change in this journal entry would be that we put it into accounts receivable. So in C, if the maturity date, assuming the note was dishonored, so C just references part C here, we would do the same exact journal entry, it's just we're going to put it back into accounts receivable. Okay, triggering our collection department to go and continue working with this customer to say, okay, you owe us, please pay. It's past its maturity date, we're going to go ahead and record it into accounts receivable. All right, so that's this chapter. I encourage you to read through it slowly, take your notes, practice, do your journal or your lots and lots of note cards for this chapter. It's a long chapter, and just really try to work through and get success on this. Chapter 9, so not chapter 8, but chapter 9 is going to have a lot of these similar concepts in it with notes. So if you can get it down in chapter 7, that's going to make chapter 9 that much easier. So if you have questions, make sure you seek help. Have a great day.